So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and today we're going to be embarking on our second options beginners master course for those of you that are in the process of learning how to trade options. The second course is really designed to compound on what you've learned in the first course, which is more theory based, understanding what the difference between a call or an put is, getting into the differences between buying and selling calls and puts. Today, and in this course that we're about to embark on now, what we're going to do is we're going to talk about how to actually utilize these strategies that we discussed for your actual portfolio with some real world strategies that you can implement for your trading. So today we're going to be talking about enhancing your equity positions using options. So this is predominantly going to be focusing on the selling side of options. We're going to be talking about selling calls and selling puts for your portfolio. Now, these two strategies, if you attended our first course, you'll know that selling calls and puts has unlimited risk. And this is not necessarily a strategy that a lot of people want to take, taking on unlimited risk. So what we want to do is we want to show you how your equity positions, meaning your stock and your ETF investments, provide the right vehicle for you to utilize these strategies in without necessarily taking on unlimited risk, and put it into the context of your existing stock and ETF investments, and show you how we're actually going to reduce risk in your portfolio by utilizing options to enhance your stock or ETF positions. Now, before I get started, how many of you currently invest in stocks or ETFs? Please type 1 into the chat window if you do invest in stocks or ETFs. And while I wait for you to respond, I just want to do a quick disclaimer. What we're going to discuss here is purely for educational purposes. It is not a recommendation or solicitation to buy or sell any specific securities. And I just want to say, for those of you that are here attending today, I hope that everyone is staying safe and staying home. We're all fighting this fairly difficult time for our global economy, and I really hope that everyone is able to stay safe during this time. So for those of you that are brand new to OptionsPlay, welcome. You can sign up for a free trial you can sign up for a free access to the OptionsPlay platform by going to optionsplay.se. I'm going to be using this platform here today to show you some real examples of some stocks that you can utilize these strategies that we're going to teach you here today, which gives you access to educational webinars. It'll give you access to a free options video library to help you learn more, and also retake the first course for those of you that want to revisit that education after you finish today, as well as we publish weekly cover call and short put reports. So the strategies we're going to teach you here today, we're actually going to start publishing ideas for you Monday, Wednesday, and Friday. So you're going to start getting emails from us Monday, Wednesday, and Fridays for trade ideas, cover call and short put ideas, as well as a market outlook. So that's going to be going out multiple times a week going forward. So not only are we here to teach you the education, but also we're here to provide you with the research and the ideas to allow you to continue to implement these strategies in your portfolio. Now, how many of you have already sold a cover call or a cash secured put in your portfolio? If you have, please type 2 into the chat window. So this is if you have already sold a cover call or a cash secured put in your portfolio. Okay, so I see one person who's responded, and again, if for those of you that have never traded a cover call or cash secured put, I hope that this is useful for you in terms of understanding these strategies. But today what I'll do is I'll start off the session by showing you some of the slides that will teach you the concept. And then more importantly, what I want to do is I want to show you on our platform, which again is the link that I just sent everyone before. And this platform is now available in both English and Swedish. So regardless of what language you prefer, you can utilize OptionsPlay to implement what we're going to teach you here today using the stocks and ETF investments that you have in your portfolio. So today we're going to be talking about the top 2 income strategies. These are cover calls and cash secured puts. We'll talk about why we want to teach you these strategies in the context of your equity investments. A lot of people say, well, aren't you here to teach about options? Yes, we're here to teach about options, but this specific topic that we're here to discuss is more so for you to enhance your stock positions. So options can be utilized to speculate. You can use them for leverage. for a directional view. But most people, most professionals, most retail investors actually utilize options to improve the risk and rewards of your stock positions, and that's what we're here to talk about. So even if you've never traded options before, even if you're not sure that you want to trade options, you should at least think about your equity investments and how options can be utilized to improve those positions. So then once we get into those strategies, then we'll talk about what are the optimal income strategies, meaning how do you select the best expiration date and strike price for your strategies. And then lastly, I want to show you the weekly cover call and short put reports, which is all designed to help you implement what you learned here today, and then show you how to automate this type of strategy using OptionsPlay. So a lot to cover here today. Let me go ahead and let's jump right into it. So first and foremost, whenever we talk about income strategies, meaning when we talk about strategies that can benefit your stock positions, most options education will start with a strategy called cover call. Many of you that are experienced options traders, you may have already sold a cover call before. But what I like to do is usually start off by talking about selling a put. And the reason I do this is because selling a cover call requires you to first own the stock. Now, how do you buy that stock? You either have to place an order, a limit order or a market order to buy the stock. So what I'm first starting off with is an alternative to your stock purchase. So many of you that have traded options or have sold a cover call may not have thought of selling a put as a way to purchase your stock, but it's actually a really good way to purchase your stock because it provides a discount on your purchase. Because when you sell a put, you have an obligation to buy the stock at the strike price that you sold the put at, which is similar to placing a limit order to buy the stock at a specific price. The only difference is that when you sell a put, it delivers at least 100 shares per contract, meaning that's the minimum amount that you can trade, minimum increment that you can trade in. When you sell a put, it requires you to put up cash or margin in order to sell that put. Similar to when you place a limit order, you have to have cash or margin to place that limit order. But the difference between a limit order and a short put is that a short put allows you to acquire the shares at a discount because the premium that you receive by selling that put is the discount factor that you're going to receive on your stock purchase. If you place an order to buy a 100 crown stock at 100 crowns, then you will eventually, when the stock drops below 100, you will purchase that stock at 100 crowns per share. But when you sell a 100 crown put, you're going to be able to receive some premium for it. Let's say you receive a couple of crowns. Those couple of crowns will provide you with a discount on the stock purchase. So right off the bat, I think most people will say, would you rather purchase a stock at 100 crowns or 98 crowns? Most people would say, I'd rather purchase it at 98 crowns. So this is the first step in enhancing your equity positions, is by buying your stocks at a lower price than what you can on the open market. And selling puts allow you to do that. So when you sell a put, there are two possible outcomes. The stock can be above the strike price, at which point your put option will simply expire worthless, just like a limit order that never gets filled. The only difference is that when you sell a put that expires worthless, you keep that 2 crowns. You can sell another put, collect another 2 crowns, and maybe get a 4 crown discount on your stock purchase. You can keep doing over and over again. We call this rinse and repeat for additional income, as long as you still want to buy that stock. Now, the second scenario is the stock moves below your strike price. And in this particular case, you now own the stock at the strike price minus the premium that you receive. Okay. Now, I know I threw a lot at you, but I just want to make sure everyone understands this concept that you can sell a put and purchase a stock by selling a put and receive the premium as a discount on your stock purchase. If this makes sense to you, please type 3 into the chat window. Perfect. Okay. So now that we've learned using a short put as a strategy to acquire your stock, now we can take a look at selling cover calls, because cover calls, again, is a strategy for when you own the stock. So let's say you now own the stock at whatever price that you acquired the stock at. Let's say it's 98 crowns or 97 crowns, whatever price you own the stock at. Now that you own it, what can you do? So First of all, let's backtrack and understand, why do you own a stock? You own a stock because you think it's going to increase in value, right? So you only buy a stock because you think it's going to move higher in price. So what's the point of a stock moving higher? So that you can sell it at a higher price to make a profit, right? That's how you make money by buying the stock, is by buying it at a lower price and hopefully selling at a future date at a higher price. So a cover call is really just the strategy that allows you to potentially sell your stock when it rallies higher sometime in the future. So selling a call option, what does selling a call option do? It obligates you to sell the stock at a specific price, similar to a limit order, right? So let's say you own a stock at 100 crowns. You think it's going to rise to 110. So you could place a limit order at 110 and wait for the stock to rise. When you sell a call option against the stock that you own, you're doing effectively the same thing. You're obligating yourself to sell your stock at a higher price sometime in the future. Now, the difference here between a limit order and selling a cover call is that you could only trade in 100 share increments. And this is really a strategy that allows you to profit when the stock rallies significantly. Now, I have a double asterisk next to that sign, next to this statement, because that statement is technically only true if you follow the strategies that we're going to lay out here today. So when you sell a call option against the stock that you own, you have two possible outcomes. At the expiration date, the stock can either be above the strike price, during which time you now sold your stock at your target price, at the strike price for a profit, or the stock could be below your strike price, which means that you, again, that call expired worthless, so that you can rinse and repeat. So imagine a limit order that never gets filled on a stock that you own. That order will just sit there for as long as it takes, whether it takes a day, a month, a year, 10 years, however long it takes for that stock to recover to that price. You're going to be able to, you're just sitting there. You can do the same thing with a cover call. The difference is that with a cover call pays you some income so that you can continuously have that limit order out there to try to sell your stock at a higher price, but get paid every single month that you have that limit order out there. So the short put allows you to buy your stock at a lower price or at a discount, and a cover call allows you to extract yield, extract income while you wait for the stock to rally so that you can sell your stock at a higher price sometime in the future. So I just want to make sure, again, everyone understands this before I move on. So please type 4 into the chat window if this strategy makes sense to you, as to why you want to sell calls to get in at a discount, and why you want to sell cover calls to continuously, why you want to continuously sell cover calls as you own your stock. Okay, perfect. I see a bunch of 4s. So let's just do a very quick example. I've already kind of went through this, but I want to show this to you in a more concrete example. So let's say you have stock XYZ that's currently trading at 100 crowns a share. So let's say you want to buy 100 shares of this stock at 95 crowns. And your target price is that you think that it's going to, you want to buy it at 95, and then you think it's going to increase in value in the future to 110. So what I want to do is I just want to do a quick comparison. So on the left-hand side, what you have is a stock investor. On the left-hand side, you have a stock investor. This is someone who doesn't trade options. And on the right-hand side, you have an options investor, someone that does trade options. So as an equity investor, you would just simply place a limit order at 95 crowns and you would wait, right? That could take a few minutes, a few days, a few months. But as long as you place that limit order, the second the stock goes below 95, you now own the stock at 95 crowns. Your potential reward here is 15 crowns per share, because if you buy at 95, and eventually sell at 110, your maximum gain here is 15 crowns per share. And you have no exposure in XYZ until it declines to 95 crowns, meaning you have to wait until the limit order gets filled before you own stock XYZ. On the flip side, as an options investor, what you can do is you can sell a put option and collect some income. In this particular case, I'm going to place sell my put at the same price that I would place my limit order at, which is 95 crowns. But when I sell this put, I get paid, let's say, 2 crowns. So now my risk is lowered because I immediately receive 2 crowns. No matter what happens, even if this stock goes to 0, my risk is only 93 crowns per share. So the second I sell my put option, I'm already immediately in a better position than anyone who placed a limit order because number one, I've reduced my risk down from 95 crowns a share down to 93. This doesn't happen at expiration. This happens immediately once you enter that order. So this is really where I always tell equity investors who have not necessarily considered options as a strategy to really, I think this is one of the most powerful strategies that most equity investors do not think of using in their portfolios because you can immediately reduce the risk of every single equity investment you make by simply selling a put option because the income is received on the opening of the trade and your risk is immediately reduced by those 2 crowns just by selling that put. Now, what that also does is it increases your potential reward because now, because your risk is 93 crowns a share, if it eventually moves up to 110, your maximum reward is now increased from 15 crowns a share to 17. And the difference here is that when you place a limit order, you have no exposure whatsoever. So if the stock never goes to 95, you never gain anything, you never lose anything. When you sell a put option, you gain immediate exposure. You start receiving income. So if the stock never declines to 95, you can continue to sell puts on that stock, hoping to buy the stock. But as long as you keep selling puts, you're going to keep receiving income. So that's the primary difference. So you get a better risk to reward and you get to gain exposure or collect yield as you wait for your stocks to execute. So this is just a quick numeric example of what I just showed you in the first slide. I just want to make sure everyone understands that. So please type 5 into the chat window if this slide makes sense to you. Perfect. So now that you own the stock at 95 crowns or 93 crowns, depending on whether you're a stock investor or an equity investor. So again, we're going to draw this line down the middle, stock investor on the left-hand side, equity option investor on the right-hand side. As the stock investor, if let's say your limit order gets filled, now you own the stock at 95 crowns a share. Now you're waiting for the stock to rally back up to that 110 so that you can hopefully sell your stock at a profit. So as the stock investor, your risk to reward stays the same. Your risk is 95 crowns a share. Your risk is 15 crowns a share, and you have exposure in stock XYZ until it rises to 110. Your limit order gets filled, and you're out of that stock. As the options investor, you have a lot more. You have a few options here. First of all, you can sell covered calls against it. So in this particular case, what we're doing is we're selling a call at the price that we want to exit this stock at. So let's say I want to exit at 110. So I sell the 110 covered call. In this particular case, let's say I collect 1 crown for this call option. For every call that I sell, I'm just going to continuously reduce the risk that I'm taking on my equity investment because originally I went from 95 crowns, I reduced it by 2 crowns by selling the put. And then if I sell another call, I reduce it by 3 crowns. And you can actually continuously do this. As long as the stock does not go above 110, you can keep selling calls. And the more calls that you sell, the lower your risk becomes on your equity investment. So think about all the trades that you have held in your portfolio that you might have held for months, maybe even years that you've held in your portfolio. Guess what? When you hold the position, your risk remains exactly the same. But when you're an options investor, you can continuously reduce the risk of your stock positions. So you're continuously reducing the cost basis, which also consistently increases your potential reward. So let's say you sell this a few more months before the stock rallies up to 110. Now, maybe instead of risking 92 crowns a share, maybe at that point you're only risking 90 crowns a share. So now your risk to reward gets even better. Your original investment is only 90 crowns, and you're now making 20 crowns to the upside. But the more calls you sell, the better the risk to reward becomes. And as long as you hold on to this stock, you can continuously sell covered calls against it and generate yield. Now, this is where I think my philosophy on covered calls really differ from a lot of other teachers of options, because a lot of people teach covered calls as an income strategy. From my perspective, a covered call certainly provides you with income, but that's not the most important part of a cover call. The cover call is really designed so that even if you're not watching your screens, that when this, sometimes the stock just rallies out of nowhere, right? Maybe some good news comes out of somewhere that you didn't anticipate. Maybe the market just has a really strong day. And what you want to be able to do is you want to take advantage of when the stock markets rally or when the stocks that you own rally and take profit, because an unrealized gain in your portfolio doesn't mean anything. It only means anything if you're able to realize your gains. And cover calls is really a way to realize those gains on your stock investments when they do rally significantly. And then the secondary benefit of that is that you get paid some income while you wait for that to happen. So, that's the way that I typically like to look at cover calls: is selling puts to generate to buy your stocks at a discount, and then cover calls is a way to just simply take profits on your stock investments when they rally, and then generate some yield on the side while you wait for that to happen. So I just want to make sure everyone understands that. Please type 6 into the chat window if these numbers make sense to you. Perfect. Okay, I see a bunch of 6s. Great. So, this is just a quick summary of this. I'm going to go through this fairly quickly because I have a lot of things I want to cover with you. But just to sum up, I think I just did it fairly quickly, is selling puts allow you to acquire shares at a discount. Cover calls allow you to take profit on your shares during a strong rally. And the goal is to really generate an income stream both on the purchase and the sale of your stock investments. So sell puts generates an income stream while you wait for the purchase. Cover calls generates an income stream while you wait to sell your stocks. Now, there are some limitations to the strategy. First and foremost, I think the most important one is that this strategy requires you to trade in 100 share increments. A limit order you can place for any number of shares. A cover call or cash secured put only in 100 share increments. So you may not be able to do this for all the strategies that you want to implement. The second thing is that you can potentially miss out on some opportunities because a limit order gets filled as soon as the stock reaches that price. So whether it reaches that price, it immediately bounces off, or it goes below that price. But the second the stock reaches your limit price, it'll get executed. In a short put or a cover call, that's not always true because the stock can actually go below your strike price and then come back above it before the expiration date. So let's say this is the expiration date. The stock can actually move below your strike price, move back above it, and then your short put never gets executed, meaning you never own the stock. You keep the income, but you never own the stock. So there are some limitations. You have to be fairly patient because these trades will generally only execute at expiration. So those are two primary differences between placing a limit order and selling a put. So now that everyone understands the strategy, let's dive a little into the mechanics, meaning how do you select expiration dates? How do you select strike prices? I want to get into some of that, and I want to try to give you as many examples as possible. So when you sell any type of option, whether you're selling covered calls, cash secured puts, you have a lot of choices as far as expiration dates. You can choose short dated options, medium dated options, long dated options. The further out in time you go, the more income you're going to receive. So many investors that are seeking income when you're selling covered calls or cash secured put, what I see is that a lot of them go out longer term because it shows you that you get higher income if you go out further in time. So what we did is we did a lot of research on this. We sold a bunch of, or we back tested selling short dated options and long dated options. And we wanted to see where do you get the most income, because people tend to gravitate towards longer dated options because, when you're looking at an option chain, you see higher amounts of income on the longer dated options. So what we did is we tested these types of strategies, and what we found is that you generally want to stay towards the shorter term, which is very counterintuitive. A lot of things about options trading is very counterintuitive because short term gives you less income. Why would you want less income? And the answer really comes from two primary reasons. Number one, we generally found that it's best that when you're selling options that you avoid selling during earnings. We know there's earnings 4 times a year. So how do you avoid earnings? You avoid earnings by selling short-dated options. So if you sell 1-month options, you can do a 1-month option 12 times a year. So out of the 12 times, you can actually stop selling the 4 months that there are earnings and still sell options the other 8 months. If you sell a longer dated option, let's say you sell a 3-month option, you can only do those 4 times a year. So every single call that you sell has a large uncertainty factor built into it. So it makes more sense to sell short dated options, avoid the 25% of the time or 25% of the year where there are earnings, and then just simply sell the other 8 months out of the year. That's the only way to avoid earnings. That's number one. Number two, which is the real reason and the better reason as to why you want to sell short dated options, is that when you go further out in time, you see higher premiums, but the premiums that you receive by going further out in time is not linear to the amount of time that you go out. What that means is that if, let's say you sell a 1-month call, let's say you collect, let's say for a 1-month call, you collect 10 crowns, right? So if you sell a 3-month call, are you going to get 30 crowns for it? The answer is no. The answer is you're really only going to get roughly 20 crowns, which means that I can actually sell a 1-month call for, in the 3 months time, I can actually collect a total of roughly 30 crowns in 3 months, versus if I sold a 3-month crown, all I'm going to collect is 20 crowns. So you can actually make more money in the long run selling shorter dated options more frequently than selling longer dated options less frequently. It adds up to be more in the long run. Okay, so does that make sense to everyone? Please type 7 into the chat window if this makes sense, because this is very, very important for options trading. Because again, there's a lot of things about options trading that's a little counterintuitive. And this is one of the things that in my opinion, is very counterintuitive about options trading, is that when you're selling options, why you want to sell the options that have the very small premiums. So now that everyone understands why when you're selling options, you want to use short-dated options, now let's take a look at how do you select strike prices, right? Because when you look at an option chain, there are a lot of different strike prices that you can sell. Now, selling puts versus selling calls, you have a different way of choosing strike prices. So when you're choosing strike prices, you can really choose strike prices of a lot of different examples, right? So let's go back to our original example. Let's say you have a 100 crown stock, right? So the stock is currently trading at 100 crowns. And you look at your option chain and you have a lot of these different choices, right? You can sell the $98 puts, you can sell maybe the 95 puts, and then you can maybe sell the $90 puts, right? And there's a whole range of strike prices that you can have going all the way down or all the way up, right? But I'm just choosing 3 strike prices here of 98, 95, and let's say 90 crowns, right? So when you're selling put options, the conservative strike prices are the ones down here, the really low strikes. These are much lower. They require the stock to make a much bigger dip before your trade is executed. And for these really low strikes, you're going to get less income. For the aggressive strikes, these are much closer to the current price. These are much higher strike prices. They require the stock to make a much smaller dip before you own the stock. And for these higher strikes, you're going to get more income. So the question is, where do you want to sell your puts on a $100 crown stock that you want to own? So we also tested this to give you a sense for where do you want to spend your, where do you want to choose your strike prices when you sell a put option? And the answer is the more aggressive strike prices. Now, there's a couple of reasons for this. Number one, the reason that you want to sell a more aggressive strike price, meaning these right here, the 98s, one's very close to the current price, is because when you sell a put, you're selling a put because you want to own the stock, right? You don't want to sell puts on a stock that you don't want to own. So number one, you want to sell a put option that gives you a high probability of owning the stock because you think the stock is going to go higher, right? So you want to participate in that. In order to participate, you need to own the stock. So if you sell a $90 put, there's going to be a low probability that you're going to own the stock so that when the stock eventually goes higher, you're not going to be part of it. You want to be able to own the stock. So when you sell a $98 put, you have a relatively high probability of owning that stock. And the benefit is that the higher strike prices give you higher income, which means a larger discount on your stock purchase. Because when you sell this $98 put, you might collect maybe 4 crowns for that. A 95, you might collect maybe 2 crowns. And then 90, you might collect only 1 crown. So here you're getting a 4 crown discount. Here you're getting a 2 crown discount. Here you're only getting a 1 crown discount. So really, when you're selling puts, it never makes sense to sell stuff down here because number one, you have a low probability of owning the stock and you're getting a very little discount. Here, you have a much higher probability of owning the stock and you get a much larger discount. So when you're selling puts, you want to sell puts close to the current price of the stock. Does that make sense? Please type 8 into the chat window if that makes sense to you. Perfect. Okay. Now that you own the stock, you think it's gonna rise sometime in the future. You want to sell the stock. Now we can think about selling cover calls. So let's say now we own the stock. Let's say we sold that $98 put and we ended up owning the stock with a 4 crown discount. So our net cost basis on the stock is, let's say, 94 crowns. So we own the stock at 94 crowns and we think the stock is going to go higher, right? We think it's going to go higher. We're not sure how much higher, but we think it's going to go higher. So let's take a look at this, right? So maybe, you look at the cover calls, you look at your option chain and you see that, okay, maybe I can sell the 100s. Maybe I can sell the 105s. And then maybe I could sell the 110s. And so when we talk about the conservative strikes, we're talking about these really high strike prices. This gives your stock a lot more upside, right? A lot more room to grow before you sell your stock for a potential profit. These really high strikes, they're going to give you substantially lower amounts of income. So if we look at these strike prices, so that we have the 110, 105, 100. So when you sell the 100 calls, you might collect maybe, let's say 3 crowns, 105s maybe 2 crowns, and then maybe the 110s maybe 1 crown. These aren't exact, but this gives you a sense for just the type of premiums that you would receive. So the higher strike prices, the further higher it goes, the more conservative you are, the less probability the stock is going to go from 94 to 110 by your expiration date. So you're going to collect less income. You have a much higher probability that the stock goes from 94 to 100, so you're going to collect a higher amount of income. So the question becomes, where should you sell your calls? Excuse me. Where should you sell your cover calls? So we also did some research on this to give you a sense for where do you want to sell your call options. And the answer is the more conservative strike price. Whoops. Let's see if I can, whoops, crap. I can't get that back. Anyway, the answer is you want to sell the more conservative strikes. You want to sell these 110 strikes up here. And the reason for it is because if you think about it, we think about a lot of people, they choose the more aggressive strikes, the 100 strikes, because they look at the option chain and they're saying, well, I want 3 crowns in income. I don't want 1 crown in income. Why would I only want 1 crown when I can get 3 crowns? But ask yourself, why are you selling covered calls to begin with? You're selling covered calls because you own the stock. And you have to ask yourself, why do I own the stock? You own the stock because you think it's going to rally, right? That's the only reason that you're taking on the risk of 94 crowns a share. So it doesn't make sense to cap your risk. In this particular case, you're giving up, in this particular case, 10 crowns in upside, right? Because if you can sell your stock at 100 or you can sell your stock at 110, if you sell your stock at 110, that's an extra 10 crowns in profit. But you're giving up 10 crowns in profit for just 2 extra crowns. Guess what? That's not worth it in the long run. Yes, you're going to collect a little bit more income in the short run, but guess what? Once in a while, the stock is going to make a big move to the upside, and you're not going to be able to participate in that. So you've taken on all this risk of this stock potentially going down to 0 in exchange for just 6 crowns. And you did it for just an additional 2 crowns. And what we're saying is, based on our research, it's better off to sell these really far out of the money options that's going to collect you smaller amounts of income, because in the long run, what you're going to be able to achieve is once in a while, your stocks are going to rally significantly, many times for reasons that you don't anticipate. Maybe some news comes out, maybe the market has a pretty strong month. Think about last year, think about how strong the markets were last year. If you consistently sell more aggressive strike prices that have more premium, what you're doing is you end up giving away a lot of the upside, which is the real reason why you even own that stock. So in the long run, based on our research, whenever you're selling covered calls, it's most important to sell these really conservative strike prices up here, these 110 strike prices. You're going to get less income, but what you're going to get is capital appreciation for the stocks that you own. So I just want to make sure everyone understands that the lower amounts of income is going to equate to a larger gain in the underlying stock. And the larger gain in the underlying stock is the most important thing that you should prioritize, because the stock investment is actually where you're taking on the most risk. So you want to make sure that you're compensated for that risk by choosing to have larger gains in your underlying stock. Now, does that make sense, everyone? Please type 9 into the chat window if that makes sense to you. Perfect. Okay, so just a few tips before we jump to some real examples here. And again, I think this is probably something that we've already discussed. Acquiring your shares at a discount by selling cash secured puts, selling covered calls immediately after acquiring your shares. I get a lot of questions from users. You know, they buy a stock, let's say at 100 crowns, and you know, they tell me, oh, you know, this stock investment didn't really work out. You know, it's down to 50 crowns, and they say, well, should I start selling covered calls now? The answer is that's probably a little too late to start selling covered calls, because at that point, maybe you might be able to sell a call at, I don't know, 55, 56. So at that point, you know, even if the stock gets called away, you're still losing 45 crowns on this. So it's too late to sell covered calls when you've lost half of your investment. You know, a lot of people come to me asking about selling covered calls when it's too late. So it's really important that when you're start selling covered calls, you do it immediately after you acquire the shares. So you're selling these, you know, 110 calls as opposed to, you know, 55 calls on this particular trade. When you're selling options, again, this is one of the more counterintuitive parts about trading options, is that when you're selling options, you want to choose shorter dated options, even though they provide less income, because you're going to be able to do it more frequently, which adds up to more income for you in the long run. When you're selling puts, you always want to choose strike prices near the current price. So if you have a $100 stock, maybe about a 98, 97, somewhere in that type of range. So a price near the current price of the stock. When you're selling covered calls, you want to sell something further away, maybe the 110s, 112s, something further away. So it's really important that when you're selling covered calls versus cash secured puts, you have very different ways of selecting your strike prices. And lastly, you want to avoid selling covered calls going into earnings. So if you have a stock that reports earnings in 7 days, don't sell a covered call that expires in a month, because you're taking on a lot more risk for selling that covered call going into earnings. So wait till the earnings cycle is over, then start selling your covered calls. So that's a quick summary of what we want to discuss here today. So let's jump over to OptionsPlay here. This is the tool that you all have access to free of charge. I hope that you guys have been able to sign up and utilize this. How many of you currently have an account for OptionsPlay? If you do, please type 1 into the chat window. Okay, so it looks like most of you have a OptionsPlay account. Perfect. So what I want to do is I want to show you how you can utilize this tool to find or execute the strategies that I'm showing you. And I'm going to show you 2 different ways to do this. Number 1, when you log into the platform, you can pull up your watch list. And I highly recommend, for those of you that have a stock portfolio, create your own watch list. Create a watch list of stocks that I own, something like that, and add to the list of all the stocks that you own. You know, many of you own H&M, maybe some of you own stocks like AstraZeneca, whatever stocks that you own. Whatever stocks that you own, add them to a watch list, because what it's going to do is it's going to make looking for strategies really easy. Or you can just use our watch list that we've already created for you, because what you can do here on our platform is there's a tab here on the right that's called income. Now, you can certainly use the trading tab for those of you that are interested in speculating on the direction of a stock. But for those of you that are stock investors, you want to focus more on the income tab. And the income tab is going to be really useful, because you can type in any stock. So let's say I go to the stocks that I own. let's say I own H&M, or sorry, if let's say I want to own H&M. So what it does is it gives you an option. Do you own shares of H&M? You can either select no, and it will select puts for you, or you can select yes, and it'll select cover calls for you. And you can use the income settings at the bottom to choose how you want to sell your cover calls. So when you're selling cover calls, I, again, prefer to do short-term options. When I'm selling cover calls, I like to be either optimal or conservative. When I'm selling puts, I like to be short-term, but I like to be more aggressive. So you can set your own settings. And we built this so that everyone, some of us are a little different in terms of how frequently we trade or how aggressive we like to be. You can save this as default. And any symbol that you type in or any symbol that you click on your watch list, we will show you which put options to sell, which cover calls to sell, depending on whether you own the stock or if you're trying to buy the stock. So here on AstraZeneca, trading at 882 crowns, if let's say I wanted to sell, if I wanted to own AstraZeneca, this is telling me to sell the April 24th, 840 puts. So AstraZeneca is at 882. This is telling me to sell a put option that expires in 23 days, so roughly 3 days away. That's 40 crowns lower than the current price. It's 40 crowns lower than the current price. This has a relatively high probability of owning the stock because 40 crowns is pretty close to the current price. You're talking about 5% lower than the current price. And guess what? I'm collecting 1,750 crowns on this stock purchase. So to buy 100 shares of AstraZeneca, you typically at 840 crowns, you would need 84,000 crowns. So to place a limit order to buy AstraZeneca at 840, you would need 84,000 crowns. But here, when you sell a put option, you don't need 84,000 crowns. You only need 82,250 crowns because you received a 1,750 crown discount. That's the premium that you receive on selling that put option. And that equates to 1.98% of the underlying stock price. So what this means is that you're getting a 2% discount on your stock purchase by selling a put option rather than placing a limit order. So this is a very good example of how you can utilize options in the way it is today to immediately reduce the risk of potentially owning AstraZeneca. Because if you put in a limit order, you immediately are taking on 84,000 crowns worth of risk, because if that order gets executed and the stock goes to zero, you lose 84,000 crowns. When you sell a put option, you immediately reduce that risk from 84,000 crowns to 82,250 because that 1,750 crowns is immediately yours the second you sell that put option. Does that make sense to everyone? Please type 2 into the chat window if this example makes sense to you. It's really important that I show you some real examples because this puts a lot more context into what I just showed you using the PowerPoint slides, because and volatility is a little high right now. So 1.98%, 2% discount is a bit on the higher end. I think on average, when things are more normal, this average is probably closer to 1.5% discount. But this gives you a sense for some stocks that you might already own. Let's take a look at H&M. H&M is a very popular stock that many of you either already own or maybe are thinking about buying, especially in this market environment, trading at a much more reasonable multiple than it was trading a few weeks ago. Let's say you want to buy the stock. It's trading at 123 crowns right now. This is selling for 100. This is telling you to sell the April 24th 115 put, which again expires in 23 days. This gives you 380 crowns for every 100 shares. So normally, if you wanted to buy this stock at 115 crowns, you would have to post 1,150 crowns in order to purchase that stock. Here, you don't have to post 1,150. Here, you only have to post 11,120. So you have a 380 crown discount per 100 shares. Now, how much is that? That is now 3% discount. So H&M is a more volatile stock than AstraZeneca. It has certainly taken a much larger hit over the last couple of months compared to AstraZeneca. So that's why you're going to get a larger discount. So you can ask yourself now, next time you think about buying a stock, Do you want to place a limit order, or do you want to take a look at selling a put option? Now, not every single time you sell a put option are the premiums going to be this good. Sometimes you might sell a put option, and one thing I just want to note, I just noticed this. H&M has earnings in 2 days. So part of the high discount factor that you're receiving is because earnings is coming up. So if you want to take on the risk, you can, but I generally would say that considering you have the risk that this stock can maybe revisit this 105, 110 low here, that you may not want to take on the risk, that you might want to wait after the earnings. After the earnings, you're not going to get 3% discount. You might only get 2% discount. But generally speaking, I think the extra 1% is not worth taking on the risk of earnings. So if I were you, I would wait a couple of days, come back after April 3rd when H&M has reported earnings. At that point, selling a put option might only get you 1.5% or 2%. But you have a lot more information at that point based on where the earnings announcement is. Maybe even after the earnings announcement, you decide you don't even want to own the stock. So you can make that decision then. But this just gives you an understanding as to how much premium you can actually receive, how big of a discount can you actually receive. And then if you do own the stock, let's say you do own H&M, how much premium can you receive from selling a covered call? So let's say you own this stock right now. Let's say you bought the stock at 123. And you're saying to yourself, well, if this stock rallies in the future, I want to be able to take profit, right? So here is where covered call comes into play. So here we're selling a 137.5 covered call, which is roughly around one here, right here. So it would have to make, another move to that high in order to take profit. This will collect 100 crowns, which out of the, roughly 12,000 crowns that you own, 100 crowns in 23 days is 0.8% of the underlying stock price. Now that's 0.8% in 23 days. Now we usually think about our yield in terms of annualized, right? So when we think about our dividend, we think about how much are we receiving for the whole year and how much yield are we receiving. And that's why we have the 12-month projected yield, which tells you that if you were able to sell cover calls for the whole year at these types of premiums, how much yield would you get? You would get roughly 12.9%, which is almost double the 7.6% you're going to receive today on H&M. So what that means is that if you add the dividend plus the cover call yield, that comes out to be roughly 20% yield on the stocks on this particular stock. So you're increasing your yield on the H&M stock that you're owning from about 7% to almost 21%. These are the types of yields that you can expect to add to your portfolio by selling covered calls. And you can do this for any stock that you own in your portfolio. You don't have to pull up option chains. I know a lot of you like to use, option chains. Some of you, some of your brokerage firms provide you with these types of options chains. And I know that for a lot of people, this is quite difficult sometimes to navigate. So if we look at H&M, trying to select which cover call makes most sense for you using a page like this sometimes can be very challenging to decide what expiration date, what strike price. OptionsPlay was really designed so that you don't have to spend all that time in those pages, and all the metrics that you need to decide, is this enough yield, is all on the same page so that you can click on trade for to execute this trade at your brokerage firm. And we created this new short code so that you can copy and paste that into your brokerage firm for execution. So a lot of brokers, Avanza, Nordnet, they use this short code for entering your orders. So we created this so that it's a little easier for you to enter your order, and we give you all the instructions on how to enter this order into your brokerage firm. So when you're looking at AstraZeneca, let's say you own this stock right now, this is telling you to sell the 945. So notice in the short put example, we sold the 840s, which is roughly 40 points below the current price. The cover calls, we're selling the 945s, which is 60 points above the current price. And this goes back to when we were talking before in the example, in the 100 crown example, why when you're selling put options, you want to sell put options that are closer. And then when you're selling call options, you want to sell further away. So this already reflects that what I just taught you before in terms of selling puts that are closer and calls that are further away. So in this particular case, we're selling the 945 calls, which generates 830 crowns in yield for every 100 shares, which is 0.94% of the underlying stock price in 23 days. That annualizes out to almost 15% yield on a stock that pays 3% dividends. 3% is certainly, I would say, average in this current market, considering after stocks sold off so heavily, a lot of stocks are paying pretty hefty yields. But if you look at your total yield at the end of the year between the dividends and the cover call, you're looking at almost 18%. So if you just own AstraZeneca stock and you didn't sell cover calls, you're looking at 3%. If you're selling cover calls on top of it, you're looking at closer to 18%. So that's the difference in terms of yield that you're going to be received by adding this type of strategy to your portfolio. And lastly, what I do is I want to show you the cover call report. This is something that we publish and we send out to you every single Monday, but we're actually going to start increasing the frequency. We're going to start sending this out to you Monday, Wednesday, and Friday, so that regardless of what day that you end up choosing to sell covered calls, that you have an updated report to look at where you're going to get the highest yield. So it just happens to be Saab right now on the Stockholm market is one of the stocks that provides the most yield. Now, Saab is also a more volatile name, and it provides, in this particular case, a raw return of 5.29%. So the stock's trading at 35. We're telling you to sell the 39 strike price, which generates a mid price of 1.87 premium, which is 5.29% of the underlying stock price, which annualizes to 83%. So we have both a cover call and a short put report that is emailed out to you every single Monday, but we're going to increase this to Monday, Wednesday, Friday, so that you can see where you're going to get the most yield on a stock, perhaps on a stock that you might want to look at this stock for stocks that you might want to own. Because if you look at this list and you say, oh, thing B is a stock that I want to own, then you can take a look at selling this. In this particular case, the stock was currently trading at $12 at the time of the report. Selling the 11.75 strike price on thing B generated 1.6 crowns per share, or 160 crowns per 100 shares, which is an annualized yield of 181%, because 1.6 of 12 crowns is 13% of the annualized yield. So you can utilize this report to say, okay, which one of these stocks do I want to own? And if there are any stocks on this list that you want to own, you can quickly see, well, how much annualized return, how much yield, or how big of a discount am I going to receive? So if you want to own thing B, here I can get a 13% discount on the purchase of that stock. That's a huge discount on your stock purchase. Now, some of these stocks may have earnings coming up, so it's important that you keep an eye out for this, and we'll actually add that to this report. But this is really designed to allow you to quickly scan for opportunities to buy stocks, and then stocks that you own, like you can look at this list and see which one of these stocks do I own in my portfolio. Maybe you say, oh, I'm just looking at this list, and some of the names that I recognize is maybe you own Danske Bank. And you say, okay, I own the stock, so how can I sell yield again? At the time, the stock was trading at 72 Danish crowns, and now I can sell the 85 crown cover call, collect 2.1 crowns for the stock, which is a 3% yield, which annualizes out to 27%. And this is a strike price that's 17% higher than the current price, meaning it would take a 17% rally between now and May in order for that stock to get called away. That's a really good return on your investment for your stock investment. So not only do you get a 27% yield on the cover call, you're getting a 17% return on your stock if the stock does rally that much. So these are resources that we provided to you to help you better understand how to utilize these types of strategies, more importantly, how to implement these strategies in your portfolio. So I hope that this was useful for everyone here who was able to attend, to understand more about these strategies and understand what the partnership between NASDAQ and OptionsPlay have built to allow you to execute these strategies as seamlessly as possible. So at this point, what I'll do is I'll open this up for Q&A. If anyone has any questions regarding any of these strategies, any of these reports, any about OptionsPlay, feel free to ask any questions, and I'll stay on for as long as I can to try to answer as many questions as I can. And I just want to say again, in this time that we're currently in right now, I hope that everyone is staying safe. I hope everyone is staying home. I hope that we're able to get past this relatively quickly and get back to our normal lives as quickly as possible. I know, living here in New York, it is quite challenging being able to, having to do everything from home. But I really hope that everyone does their part so that we can all get back to normal relatively soon. So thank you so much for taking the time out here out of your busy evenings to listen to this. And again, I really hope that this was useful for everyone. If there are any questions, please type them into the Q&A window, and I will answer as many questions as I have time for here today. Thank you. You're so welcome. I really hope that you guys find this useful. Any other questions? Someone's asking, earnings equals dividends. No, earnings is just the corporate financial reports that come out once a quarter to let you know how much they've earned, how much profit they've earned, how much revenue and how much profit they've earned. They basically state their financials once a quarter. So when I'm referring to earnings, I'm referring to those announcements from the company as far as how they're doing financially. Dividends are different. Dividends is when they pay you effectively cash for owning their stock, or you're basically getting a return of some of their profits back to you. So those are two separate things. Any other questions? Oscar is asking if there are going to be any recordings. Yes, this whole session is recorded, so we'll send it out to you. Not only are we going to send you the recording of this webinar, we're going to send you the recording of the next webinar. Again, I apologize for the time zone confusion because we switched time zones at different times. We just happened to crisscross that last week and this week, so I apologize for that. But yes, the recordings will be available to everyone. Is there any broker in Sweden that manage combination orders like condors? Olaf, why don't you send me an email at info@optionsplay.com? I just sent the link to you in the chat window. I can certainly follow up and ask that question. My understanding is that there are a few brokerage firms in Sweden that do offer complex orders up to 4 legs like condors. So I'm going to follow up with the exchange and confirm that for you before I give you an answer. But please send me an email at info@optionsplay.com. How about the spread at NASDAQ Stockholm? Rather high as I see it. So that's a really good question. Olaf is asking a great question. He's saying, so for example, if I'm selling this AstraZeneca 945 cover call, the bid ask price is 830 by 1075. So the bid-ask price may be relatively wide, but that's why we always tell you to place your orders at the midpoint, because you can still get filled much closer to the midpoint. What you're going to find many times is that, let's say the midpoint's at 9.5. You might want to place your order maybe at, let's say you're selling, maybe you want to place it at maybe 9.4 and see if your order gets filled, right? And you can always continuously move it down a little from 9.4, 9.3. But what you're going to find is that eventually you're going to get filled well before 8.3. So I wouldn't look at this bid-ask price too much. I would just look at the midpoint and start working your way down until you get filled. And depending on the option, you're going to find many times you're going to get filled fairly close to the midpoint, 9.3, 9.4, rather than having to go down to 8.3. Can you do a cover call in the ISK account? So, Olaf, I'm not sure what ISK is. Is that the retirement account, the equivalent of a retirement account or a tax deferred account in Stockholm? If that's the case, cover calls is really a strategy that you should be able to deploy in almost all accounts. So, a cover call is the most basic strategy that you will be able to trade. So I would imagine that most places will allow you to place a an options order I'm sorry, a cover call order in a retirement or tax deferred account. But I'm happy to follow up with you on that as well, along with the Condor question. Any other questions? In options play, can you calculate butterflies? Absolutely. You can go to the trade button. Let's say AstraZeneca, and I think AstraZeneca is probably a good example here. Let's say AstraZeneca has been pretty volatile, but you think by the end of the year the AstraZeneca will be just around 900 crowns. You can click on Modify. You can use our strategy constructor, and you can select neutral strategies, which is where the butterflies are. You can select from call butterfly, put butterfly, even iron butterfly, and you can select different wingspans, well, for butterflies, you can only select wingspans. You can move your strikes up. You can move your strikes down depending on where you think AstraZeneca is going to end at the end of the year. So let's say you think it's going to be at 900, and you can select either using the bid ask or the midpoint. So using the midpoint, as you can see here, you're risking 700 crowns to potentially make 3,800 crowns if on May 15th, AstraZeneca is at exactly 900 crowns. And you can use our P&L simulator to see how this strategy performs if the stock goes higher above 900 crowns, if it's below 900 crowns, or if it's at exactly 900 crowns. So yes, you could do that, and then you hit the trade button, and then you get all 4 legs that you have to enter into your brokerage firm to trade that butterfly. So yes, we cover 45 plus different strategies. You can do butterflies, iron condors, straddles, strangles, all of that are available here. A lot of people like to trade the iron condors. You can make, maybe a larger wingspan, larger width. And everything's been designed from the ground up to try to make your trading as easy as possible, especially in these more complex strategies like butterflies and condors. Okay, thank you so much, everyone. Again, I want to thank you so much for taking the time out here this evening. I hope that this was useful in better understanding these strategies and also understanding the tools that we've implemented to help you implement these strategies. If you have any questions, always feel free to shoot us an email at info@optionsplay.com. We will send you both the recording and the slides right after we're done here today. So thank you so much. Have a great evening, and I will see you guys in a couple of weeks for part 2 of our options learning experience. Have a great evening.